Okay, summary chart on capital structure, which we call it as C5. First, what is the meaning of this? What is the meaning of or objective of capital structure, you can call it, instead of meaning? What are we trying to do in this chapter? All this you know, no? Find out optimum capital structure we'll call it as CS. Find out optimum capital structure which maximizes value of the firm or wealth of the shareholders. So that is the primary objective. Then we read some theories, no? Theories can be broadly classified into relevant theories or relevance theories, and under relevance theory we had two. What is that? Net income approach Net income approach said go bonkers on debt. Go for debt as much as possible, or use debt as much as possible. Use debt. This can be big, so tilt your books and write, and ideally keep 2 pages. Tilt your books and write it this way. First complete that page and come for this. It might be in 2 or 3 pages depending on your font size and your adjusting capabilities. You have to do jugaad. Good at jugaad, 2 pages. Otherwise maybe 10 also, who knows. Okay, use debt as much as possible. Why have to we use as much debt as possible? What is the funda of this? Because of this, what will happen? Debt is cheaper. And because debt is cheaper, it would imply what? It will imply the cost of capital overall cost of capital will reduce. So the value of the firm will increase. Yes or no? So wealth of the organization will increase because of this. That is the funda of net income approach. Next we had what is the other approach? Traditional approach said hold on macha, don't be so careless. Also use debt and equity judiciously or carefully, because though debt is cheaper and initially KO will be reduced, later on what will happen? Later on, cost of the debt after a certain point of time can increase, and equity shareholders, the moment you raise, it becomes a risky affair. So cost of equity will go up, and eventually cost of equity also will go up, and the value of the firm will decrease as per the traditional approach. That's all we don't know. Everyone, are you able to remember? These are your relevance theories. Forward, huh? She said up and she left it at that. Okay. Next is what? Though debt is cheaper and initially KO will be lesser, later on cost of debt will increase, cost of equity also will increase, so overall cost of capital will increase, which will cause the value of the firm to decrease. That's what we have written. So much I know, huh? Thank you. So much I wrote. Okay. Me writing is not the problem. You remembering on the examination day is the crux. Guys, keep revising the chart, because here many are formula, no? In a day or two you'll remember. Fourth day it'll be like, what nonsense is this? You'll come to that feelings. Okay, hence we're giving the charts. When you're revising the chart, it will not take more than 10 minutes. Wherever you're sitting, in the bus, whatever it is, you can just open the chart and quickly have a look through it. Whether you're able to memorize it and recollect it, it's okay. Just keep reading through it at least, so that you're in constant touch. So on the last day, it will not be like you're learning the subject as a new. That will not make sense. No point in having the charts then. Okay. Next theory, after relevance theory, we studied what? Irrelevance theory. Now, in fact, we could have written some more pointer also. Hang on, we'll finish off that only and then we'll come. In fact, we wrote value of the firm and all, no? We'll write all that. Here only we'll write. Do you have space? No space. Okay, after theories we'll write that. All the formulas in one go we'll write. Okay. Or okay, here you write, no problem. Just put it this and write. Value of the firm. How do you get value of the firm? We wrote two formulas. Now what is that? Net operating income, that is EBIT, divided by overall cost of capital. This is earnings approach. Or we had one more approach you could have used. V is equal to S plus D, wherein S is equal to market value of equity and D is equal to market value of debt. Correct? No? And to find out S also, we had one more formula. What is S? NI, or earnings available to equity shareholders, divided by cost of equity. Those are your formulas that we initially looked at. Have you written that? Just saying, yappa. No worries. On the examination day, you will be thankful we did all this. Now it looks like a little painful activity. There, it will help you out. Okay, irrelevance theory. First one was what? Net operating income approach, or NOI approach. What does NI approach say? It is first of all an irrelevant theory. So what does that say? Use of debt has no impact on what? On the value of the firm, they say. Because what will happen according to this? Debt is cheaper, and because of this, or this will lead to, use of debt will lead to, what will happen to the cost of equity? It will lead to cost of equity to increase, which will be equal to what? Both will get set off. Both will get set off. Hence, no impact. Hence, no impact on value is the theory this approach works on. Okay, after this we studied what theory? One more irrelevance theory was Modigliani. MM approach, can we write? MM approach. So under MM approach, two things we can write. What are those two things we can write? No tax means what? If there is no tax, then it will imply what? Cost of, we use one Sangam, Sansui and Sangamani, no? What did we use? Cost of equity, or KO of unlevered firm will be equal to KO of levered firm. That's what we use, no, in that particular question. Sangamani. This is one pointer you can write. If at all there is a tax, then what will happen? Value of the levered firm, the firm that which has a debt, will be equal to value of unlevered firm plus tax base or tax advantage. And how do you get tax advantage? Tax advantage will be what? Debt into tax rate. will be your tax advantage. So those are your approach ka funda. Next, after that, in fact, here one more you could write. If there is no tax, their cost of capital also will be same, and value of U firm will be equal to value of L firm. There is no tax base means, if there is no tax means value of the unlevered firm will be equal to value of the levered firm. Yes, and only if there is a tax, we add that tax advantage. There is no tax, then both the firms will have the same value as per this approach. Anything? Arbitrage process is there. Okay. Also told some arbitrage wala funda. So much we can't write. So we will just write in short way. What do we arbitrage? What we can write for arbitrage? 1. Find out. What do we need to find out? Find out the value of U and L firm. Overall process of arbitrage is what? Sell the shares of that firm which has higher value and buy the shares of that company which has a lower value. Sell shares of that firm whose value is higher and buy other firm's share. If you are going from levered firm to unlevered firm, what are the things you need to keep in mind? 1, you have to borrow. Borrowings will come. Yes or no? Correct. Anything else we need to keep in mind? Either you can increase the returns or you can get surplus money with same percentage. Correct? No? With same equity percentage. Is that making sense to you? We'll not increase the equity percentage, but our amount of investment will reduce. Hence, we get something known as a surplus. Did you revise? If you revise, you should be able to relate to this. Correct or no? So, I think that should be okay. Or anything you want to add on? Your chart. So, if you want, you're free. This much I feel is okay. If you want to add something, tell me. I'll add. Otherwise, okay. Move on. If you're going for unlevered to levered, then what are the things you need to keep in mind? No borrowings will be there. However, investment will be done in equity and debt of L firm in what ratio? In D is to E ratio. That is debt is to equity ratio. Again, here also you can increase the returns or keep surplus, you can write, or keep surplus with same equity percentage. Here you can write same equity percentage instead of just equity percentage. Think this is good enough? Here you can write refer class notes for detailed steps. You can link it also. It is there in note number 1, page number 42, so that it will help you on your examination day. I told you on the day 1, no? All your notes, keep numbering them. You should be able to establish the trail. Because you never know what you want to revise on the examination day. You may only want to revise chapter number 4. You will not know where it is. You will have to keep hunting. So always make an index in your notes. Chapter number 1 is there from page number 1 to 3. Chapter number 4 from page number 45 to 50. Like this, make an index so that clearly you know what to study, where to find the questions and everything. It'll be easier for you. Anyways, that and all is your work. So this is your arbitrage wala process. Next, drama. Anyone is copying any portion? Anyone is yet to copy any portion? Done. Next, after theory, what did we learn then? We have to go full top now. Full top. Okay, next. What is the next one? After theories, what did we learn? Anyone remembers? No? I think we learned something known as trading theory and pecking order theory, no? That was also there. Okay, we'll write. First one, trading theory. What is the funda of trading theory? What happened here? We are trying to get the balance of equity and debt right. Get the balance of D and E right. How are you trying to do that? By analyzing or by doing? By cost benefit analysis of debt. By cost benefit analysis of debt. What is the cost of debt, by the way? What is the cost of debt, guys? One is KD itself. You're paying some interest. That itself is one of the cost. Two, what are the disadvantages basically? One, there is a cost, and two, it might create some financial distress. If this goes on for a long period of time, that financial distress can result into financial insolvency. There could also be certain non-bankruptcy cost, like employees leaving, etc. Non-bankruptcy cost, employee leaving, etc. Alright, so also it could create some agency problem and AP and AC wala problem. Agency problem and agency cost. Benefit we know. What are the benefits? Benefits of debt is what? One is it is cheaper. Two, it is you're gonna get some tax shield or tax advantage. This came of smaller. Okay, later box then. Make one box and a pencil, so now you know what belongs to what. It should not be like full of written like that. You're not able to connect what belongs to what. Keep on boxing them. One you box, one you leave, so that you remember. If you do too much boxes, also it will be too much of a problem. So that you clearly can relate. So that is your trading theory or trading off theory. It should be, no? Trade off theory. Name only we wrote incorrectly. Meaning we have written correctly. Yes, sir. That we didn't write. So much mistakes also will not commit. Only small mistakes will commit. Trade off theory. Next what? Point number 4. Pecking. Cookie. ಏನು ಕೂಗ್ತೀರಾ? ಬ್ರೇಕ್ ಕೊಡಲಿಲ್ಲ ಅಂದರೆ ನಿಮ್ಮನ್ನೇ ಕೂಗ್ತೀವಿ ಸರ್ ಇವಾಗ. Pecking order theory. Alright, what is pecking order theory all about? Different persons have different or they have access to different source of information, have access to different levels of information, and the choice of source of finance is based on what? Based on that source which reveals lowest or highest, which reveals highest information. So priority will be what then? Priority will be what? First priority will be given to retained earnings. First priority you will give it off to retained earnings. Second, you will prioritize debt provided if earnings का outlook is equal to positive. Okay, third priority or least priority, we'll give it off to equity. Least priority. The reason being it reveals the lowest levels of information. Hence, as per pecking order theory, that is what you do. Remember 2-3 points at least, just in case they ask for 2-3 marks maximum. Okay, theory is all over then. After that, what did we do? Finance break-even point. Factors. Have you copied all this? No, sir. You know one secret, only if you have pen you can copy it. Yeah, if you keep doing that, it'll never happen. She's smart. First, she's copied. She's also going down. Anyways, over, sir. Now, okay. Next is factors. Factors what? Factors affecting CS, as in capital structure. We wrote something, no? What is that? SLR, awesome. SLRFCC. S for stability in sales and growth. L for leverage impact. R for risk factors. F for flexibility. First C for cost, last C for control. These are the factors which affects your capital structure. Next we studied what did we study? FBP, financial break-even point. What and all? Or financial break-even point, that is FBP. What and all can we remember for FBP? It's a point at which EPS is equal to 0. Alright, point, when I say point at which, I'm talking about EB80 level at which EPS will be 0, or you can write here in bracket EB80 also. Second, what can we write? That's all we learned, or anything else? Okay, for FBP, for equity, what will be FBP? One moment, I can present it this way, I guess. Otherwise I have to keep writing. FBP for, or FBP for equity. FBP for equity is 0. Second, for debt, FBP is interest charges. For preference shares, for preference share, it is nothing but preference dividend divided by 1 minus T, as in tax rate. So those are for your FBP. So you can write it parallelly. I will write it as FBP and indifference point. You can write that as a 7th point. It is okay. I have space downwards, so I'll utilize that. Indifference point as an IP. So this I'll call it as A. All this is for FBP. I'm going to write B. This is for IP. For IP, what are the points we can write? Hmm? EBIT at which both alternatives give same EPS. And to find that IP, we have a small formula, that is EBIT minus I1 into 1 minus tax rate minus preference dividend, if any, divided by E1, which should be equal to EBIT minus I2 into 1 minus tax rate minus preference dividend, if any, divided by E2. That is your indifference point. Next, anything we missed out? Sorry, sir. Okay, that also we can write. Good one. No IP for debt and preference shares. In fact, you're right. No IP for debt plan and preference shares plan. If you have only debt and only if you have preference shares, then you can't find out any indifference point. That will, because debt will always dominate. That also, if you want, you can write. Debt plan will dominate preference shares wala plan. Okay, so this is on the IP. Next is what? Overcapitalization and undercapitalization, it seems. Okay, let's write that. Point number 7. Overcapitalization and undercapitalization. For overcapitalization, what and all can we write? Point number A. What is it now? Overcapitalization. Scenario where firm has more capital when compared to its earning capacity / returns. Possible cause for this would be, causes for this could be too many borrowings, too much borrowings, or too much of borrowings, or borrowing it at high rate or higher rate. Remedy, or how do we sort out this? Remedy will write here. Remedy is, what do? Go for reorganization, or go for, maybe hang on, let's not write 1 2. Reorganization, buyback of equity shares you do, and ask the shareholders, debenture holders, creditors, etc., to sacrifice their claims. All that comes under restructuring or reorganization wala plan. So this is for overcapitalization. What can we write for undercapitalization? scenario where firm has lesser capital when compared to its earning capacity. So normally under capitalization firm, dividend payout ratio since they're not using it for further expansion, dividend payout ratio will be higher. So because this firm is earning a lot, it will bring in it'll attract the competitors. Emergence, other competitors will come in. Okay, we can write new entrants, or entrance only we write. Entrance or entry of competitors. What is the remedy? There you can go for bonus or you can go for share split up. So that's your undercapitalization from my side. Anything on the problem side you want to add on? Or do you find we should add? No. So that means that's it with respect to this particular chapter ka chart. Okay, so we'll take a break now and resume. Thank you.